A stack of inventory sheets sat on a folding table in a New Jersey warehouse, and a forensic accountant kept circling one figure that refused to behave. The number said the company owned far more televisions and stereos than any store that size could possibly hold. Not a wild sum, just wrong by a stubborn mathematical fraction. Everyone else wanted to go home. He stayed because a business this loud, this beloved, this famous for screaming insane prices on late-night television should not have a rounding problem it couldn't explain. That single discrepancy would eventually strip the varnish off a $2 billion empire, expose cash flown overseas in suitcases, and send a household name founder fleeing the country. But on that first night, nobody knew any of it. All they had was a decimal that didn't add up. To understand why a small number mattered so much, you have to understand how enormous Crazy Eddie had become. Founded in Brooklyn in the early 1970s, it grew into one of the most recognizable electronics chains on the East Coast. Its commercials were unavoidable. A manic pitchman shrieking that prices were insane, a slogan burned into a generation's memory. The stores were packed, the aisles chaotic, the discounts real enough to build genuine loyalty. Customers loved it. Wall Street loved it more. When the company went public in 1984, its stock soared, minting fortunes and turning a scrappy discount retailer into a market darling. The founder became a legend, a self-made man who understood the American shopper better than any consultant. Behind the noise, though, a quieter operation had been running for years, one that predated the IPO entirely. Long before the public offering, the business had a second set of books. In its early cash-heavy years, the family allegedly skimmed money off the top, pocketing sales, underreporting income, shrinking the tax bill. It was, by the standards of ambitious fraud, almost mundane. Hide revenue, pay less to the government. But this created a peculiar problem when the founder decided to take the company public. Suddenly, the incentive flipped completely. A private company wants to look poor to avoid taxes. A public company wants to look rich to lift its stock. You cannot spend a decade hiding sales and then, overnight, prove those sales were always there. Reconciling those two ambitions required a new kind of lie. And that lie would leave fingerprints in the one place fraud always hides worst: the inventory. Here is the mechanism, and it is deceptively simple. To make profits look bigger, the company needed to show it was holding more merchandise than it actually did. Inventory sitting on shelves counts as an asset. Inflate it, and your reported profit swells without a single extra sale. So the story goes that the skimmed cash from earlier years was quietly funneled back into the company, disguised as legitimate revenue, while phantom inventory padded the balance sheet. Auditors were shown warehouses stacked to the ceiling. Boxes were counted, recounted, moved between locations overnight, and counted again in new places as if they were new goods. The numbers grew fatter and healthier each quarter, and the stock kept climbing. But remember that lonely accountant and his impossible figure. That thread is still hanging. For a while, it worked beautifully, and this is the uncomfortable lesson buried in the story. Fraud does not usually collapse because it's clever. It collapses because it's greedy, and it must keep growing. A lie about inventory is not a one-time act. It is a treadmill. Each quarter, you have to be a little more profitable than the last to justify the stock price, which means the phantom inventory must swell a little more, which means the gap between the real warehouse and the reported warehouse widens with every cycle. The founder wasn't just deceiving the market once, he was committing to an accelerating deception forever. And an accelerating lie generates an accelerating trail of numbers. Numbers that sooner or later describe a physical impossibility no clever explanation can cover. Then the empire cracked from the inside in the most human way possible. A family feud. In the late 1980s, the founder's relatives and business partners turned on one another. A boardroom coup pushed him out of his own company. The new management walked into the warehouses expecting to run a thriving retailer, and instead found shelves that did not match the paperwork. Merchandise the books insisted existed simply wasn't there. Tens of millions of dollars in inventory had evaporated, or more precisely, had never existed at all. The people who ousted the founder had unwittingly inherited the crime scene. Now they had every incentive to prove the fraud, because otherwise they'd be blamed for it. And so the forensic accountants arrived, clipboards in hand, ready to count every last box. This is where our cold open loop finally pays off. When investigators reconstructed the inventory, they didn't find a vague mess. They found precise, damning discrepancies. The company had reported holding roughly $65 million more in merchandise than physically existed. The magic of it was in the small, verifiable details. Shipping records that didn't match receiving logs, the same serial-numbered goods appearing to be counted twice, purchase orders with no matching product on any shelf. That first stubborn figure the accountant circled wasn't an error. It was the visible edge of an entire fictional warehouse. You cannot fake a decimal cleanly forever because inventory is stubbornly real. Every phantom television has to be somewhere, and eventually someone walks the aisle and finds an empty space where a fortune is supposed to sit. But the founder had one more problem the auditors couldn't yet see, and it opens a fresh mystery. Where had the money actually gone? The skimmed cash from the early years hadn't simply vanished into the balance sheet trick. Investigators later traced an elaborate laundering operation stretching overseas. Cash had allegedly been carried out of the country in physical bundles, suitcases and body-strapped currency flown to banks in Israel, then routed through accounts and eventually wired back into the United States as if it were clean investment money. This was how skimmed dollars became sales. It was a full circle of deception. Steal quietly, hide the theft abroad, then smuggle it home dressed as success. And every leg of that journey left a paper record. A deposit slip, a wire transfer, a date that would one day be matched against another. As the civil and criminal cases mounted, the founder did what cornered men sometimes do. He fled. In the early 1990s, facing securities fraud charges and a mountain of forensic evidence, he left the country and became a fugitive. For years, he lived under assumed identities abroad, moving between countries, staying ahead of the investigators, tracing his money and his movements. Back home, the company he built collapsed into bankruptcy. The famous stores went dark. The insane jingle became a punchline about a fraud, not a bargain. But the same discipline that undid the inventory lie was now trained on the man himself. Investigators followed the financial breadcrumbs across borders, and the very transfers meant to hide him became the map that led straight to his door. They caught him. In the mid-1990s, the founder was located overseas, extradited back to the United States, and put on trial. Prosecutors laid out the mechanics with almost surgical patience. The skimming, the phantom inventory, the laundered cash, the inflated stock that had cost investors enormous sums when the truth detonated. He was convicted on federal fraud charges. Though appeals and legal maneuvering dragged the saga on for years, and portions of the case were revisited, the core reality never changed. A beloved retail brand had been a stage set, and the applause had been paid for with lies. He ultimately served time and, over the following years, repaid a portion of what had been taken. The screaming pitchman was, in the end, silenced by arithmetic. What makes this case worth studying isn't the flamboyance. It's the discipline of the detection. The fraud was loud. The unraveling was quiet. No single dramatic confession broke it open. It was patient people counting boxes, matching serial numbers, comparing shipping dates against receiving dates and refusing to accept an explanation just because it was offered confidently. The genuine insight here is this: financial fraud almost always dies at the point where the paper world must touch the physical world. You can inflate a number on a screen indefinitely, but the moment that number claims a truck arrived, a box was shelved, or cash crossed a border on a specific day, it becomes checkable. Reality keeps receipts, and a lie that must interact with reality is a lie on borrowed time. There's a second lesson, aimed at anyone who ever believes a business is too popular to be fake. Crazy Eddie was genuinely beloved. The commercials were real. The customers were happy. The discounts were often authentic. All of that was true, and none of it protected investors. The public face of a company and its financial guts are two entirely separate things, and one can be gloriously healthy while the other rots. A brand you love can still be a stock you should fear. The market treated cultural fame as if it were financial proof, and it was not. That confusion, mistaking a great store for great accounting, is exactly the gap fraudsters live inside. It costs shareholders dearly, and it is a mistake investors keep repeating in every generation. In the end, the empire that shouted the loudest was undone by the quietest possible thing: a count that came up short. Not a whistleblower's dramatic tape, not a journalist's exposé, just merchandise that was supposed to exist and didn't, described by numbers that could not lie their way out of a warehouse. The founder's genius for selling televisions could not survive contact with a physical inventory. Every phantom box had a location it was supposed to occupy, and eventually someone stood in that empty spot and understood. A $2 billion story collapsed into a rounding problem nobody could explain, because in the end, there was nothing there to explain. If this pulled you in, that's exactly what this channel is built for. The tiny detail that topples the giant lie. On Bull and Bust, we dig into the frauds, crashes, and rogue traders that history tried to forget, and we do it one overlooked number at a time. Subscribe and turn on notifications so the next collapse lands in your feed the moment it drops. Because there is always another empire built on applause and phantom inventory, another confident man certain the counting will never come. And there is always, somewhere, a patient person at a folding table who refuses to go home until the decimal makes sense. Hit subscribe, and let's find the next missing cent together. The next story is already loading. We'll see you there.